Hi, I'm Merryn Somerset Webb, Editor-in-Chief of MoneyWeek magazine. Welcome to another one of our video interviews. Here with me today is Charles Plowden, who is the manager of the Monks Investment Trust, which is currently managed by Baillie Gifford. Now, we're going to talk about the trust at some length. It is a growth trust, but there are various different definitions of growth and an awful lot of holdings that you might think don't necessarily fit into the same growth pattern, right? So let's start by talking about what you mean by growth. It's a global growth fund. What does that mean?
Yeah. Well, it's very straightforward. I mean, global just means we're choosing from the broadest possible opportunity set. There's nothing excluded for reasons of geography. So every stock that's big enough is a potential investment. And by growth, we mean companies that will grow consistently, well, perhaps not consistently, but will grow over the long term at an above average rate. And our minimum growth hurdle is typically seen as at least 10% per annum, which would itself be well above the long-term averages. So global, the broadest.
And when we're talking about growth, we're talking about revenue growth, we're talking about profit growth.
We're talking about per share metric growth, principally earnings growth, cash flow growth, dividend growth, but real growth. So acquisitive growth doesn't really count if you're funding it by issuing lots and lots of shares. So, Lord Hanson, going back to the 70s and 80s, it wasn't always, he grew his top line very quickly, but he didn't always grow his earnings per share very quickly. So a broadest possible opportunity set, and all we're looking for is sort of top quartile growth, the well above average growth, and we measure growth over 5-year periods, so we're not looking for metronomic every year on year, you always have to grow. And that's where the different categories of growth come in. So some of our categories of growth we definitely do expect every year. That's the growth stalwarts. They're only there because they are reliable and it's a repeatable process.
Okay, so what kind of company would fit into that?
Well, I mean, typically it would be the beer companies, the food companies, used to be the tobacco companies, but we don't own those anymore. We don't really own any of the food companies anymore either. These sort of public sector utilities, chewing gum, chocolate, biscuits, beer, they actually been terribly popular in the stock market recently because they're the safety first. At a time of uncertainty, everyone flocks into the most certain earning stream. And of course, we've now got all the bond refugees as well.
Yeah, but you're not seeing actual business growth in those of 10%
well,
a year,
this
are
is,
you?
No, not anymore. This is, we've had this combination that the valuations have gone up and the growth is fading away, largely because a lot of the growth has been based on emerging market opportunities where there's been a temporary slowdown and there's been currency weakness. So in a hard currency, most of those companies haven't been growing that, producing the 10% growth. But we wouldn't sell them because, the Brazilian real's gone down this year and the earnings growth's going to miss 10%. We would typically look at constant currency underlying growth rather than a sort of an accounting measure of growth. But what we're looking for is long-term compounders.
Okay, so give me an example of a company you're still holding that fits into that.
Well, Nestle is the classic example of the stock we'd held for 11 years. We've sold it at the beginning of this year because of the valuation and because what had been tailwinds for many years have become some headwinds in terms of healthy eating. The move towards healthy eating and margins have got too high. So in our view, the top line is beginning to slow. The margins no longer going to go up. They might come down a bit. So it's going to be hard pressed to produce much by the way of earnings growth, and yet it's been re-rated.
Okay, so that one's gone. So what fits into this category now today? I mean, I'm fascinated by the idea that you can actually find a stock that has reliable 10% growth a year that comes in at a price that is even remotely reasonable. Is there one you're holding today that is fits the bill?
This is one of the interesting issues because there's been so much bond money moving into regular dividend payers. As a category, they're all very expensive. So where we've been looking is the ones that have a little bit of fluff on the outside, a few what we perceive to be short-term problems, but in a long-term position of strength. So this year we bought Novo Nordisk, which has been one of the world's most wonderful growth stocks of the last 30 years, the diabetes care business. It's been warning of pricing difficulties in America, which we think are largely, they're generic problems. They're common to everyone in the drug industry, but we don't think they're going to see deflation. It's just, they're finding it harder to push through price increases. They're also at a sort of disjunct, if that's the right word, they've got a surge of new products about to hit the market over the next 12 months. So again, you don't tend to get strong price increases with older products. You get those on newer products. So we've bought that, which has been derated. It's on a high teens multiple of earnings because we think that the long-term growth will resume. It's not economically sensitive. So this is an opportunity to get into something that's having a short-term worry.
Okay.
But you're right.
So to you, the high teens feels like a reasonable valuation?
Yes, for long-term double-digit growth.
And then what would it have to get to for you to say, well, actually now it's too expensive? What made Nestle too expensive?
Well, typically the rule that we use is, is there a plausible scenario where we can double our money in the next 5 years, which is a 15% share price return over the next 5 years? And if we can't, if you really have to be wildly optimistic to get that doubling, then the chances are we shouldn't own it. So in the case of Novo Nordisk, buying what we think will be 10% plus earnings growth on a high teens multiple, we can see that the earnings growth will deliver 2/3 of our hopeful return. We're only looking for a relatively modest re-rating over the next 5 years to get our doublings. So that's, if it ends on 22 times earnings and it grows at 10%, we've got there, we've doubled our money. So we're very happy to own it because even 22 times relative to its history would look like a very fair rating.
Okay, so that's growth category number one.
That's growth category
there are
number one.
How many categories are there?
There's 4.
4, okay, we better get moving.
Yeah, no, there's 4,
Second category.
and that's one of the smaller ones at the moment. Just before we leave stalwarts, in end of 2008, early 2009, that category was 40% of our portfolios. Okay. Because we were cautious and we were worried about the sustainability of the global growth trend we were on. It's now down about 20%. So we basically, over the last several years, been taking money out of growth stalwarts and putting it into higher return, higher potential businesses. So we're down at about 20%. I should also put a proviso that all these growth categories, while Monks is now following this framework, it's only done so for 18 months. So when I'm talking about 2008, Monks was managed by a different team and a different approach in 2008. So what I'm talking about is what I've done for the institutional clients. Okay. And Monks is now following the same strategy. Okay. But I don't want to confuse people when they get their Monks annual report and say that's not
what they used to do.
So the next and the largest growth category is what we call rapid growth, and this is very much the sort of area that Scottish Mortgage is focused on. For us, for Monks now, it's about...
The Scottish Mortgage, by the way, being another investment trust that is also managed by Baillie Gifford at the moment, and which is in the MoneyWeek investment trust portfolio, so a lot of you probably hold it.
Good. Rapid growth stocks make up just under 40% of Monks at the moment, but probably more like 2/3 of Scottish Mortgage, so that's the main point of difference.
And these companies are Amazon, Tesla?
Yeah, these are companies that can grow between 15 and 25% per annum over prolonged time periods. We believe can, and we believe will, obviously, otherwise we wouldn't own them. But they have the strong potential to do so. The big names in that category and the most successful investments are the likes of Amazon, Google, Tesla, Naspers, the South African media company. So those are all, well, Tesla isn't, but those are generally companies that are embracing new technology. A lot of them are internet-based, mobile communications, data-based, but it's a broader category about innovation, about the application of technology, high return on capital, ability to scale very quickly. Mm-hmm. So growing at 25% per annum for 10 years is not nearly as implausible these days in a web-based world than it was 20, 30 years ago when you had to, build a factory in each country, set up a distribution, buy the trucks. So the fact
that you need very little capital to grow these businesses is key.
And you can scale immensely quickly. I mean, just think, and I can't remember which year Facebook was founded in, but it's certainly less than 15. I think it's less than 15 years old. And it's already global, the biggest, 1.5 billion regular users. So,
are you a regular user of Facebook?
I am.
Are you?
I am, yeah. I was an early adopter. The main reason being that I've always been very interested in social networks and the power of networks and platforms, which is, of course, what's driven that whole category of company is the power of the network, that the more people you get on, the more useful it becomes. And if you're trying to sell things like Amazon, the lower the costs, the less the friction, the more services you can offer, the more customers, and so on. So I've always been very interested by how these networks work. I did sign up to Facebook, I can't remember how long ago, but really quite early, because I felt that it was going to be a material, it was going to make a big difference. It was. I never got on to Friends Reunited though. I missed that step of evolution.
Well, could the same happen to Facebook?
Well, we think not, simply because the power of the positive cycle, the spinning wheel.
The scale is so huge.
The scale is so huge that it's now very difficult for anyone else to compete. And actually our view's gone on further, because Facebook clearly isn't the only social network, and Amazon isn't the only e-commerce website. But our view is that these networks tend to winner takes all, in which case you don't really want to put your money into the number 2 and the number 3. So in fact, for Monks over the last year, we've sold out of eBay, which is clearly falling further behind Amazon, and we've sold out of Twitter, which is clearly falling further behind Facebook. And we
think Twitter and Facebook can't coexist?
I think they can coexist, but I think Facebook is continually sort of eating Twitter's future lunch. It's jam tomorrow. And Facebook is continually trying to replicate the Twitter service, which is very interesting and useful. But if that was another button on your Facebook app, you'd much rather stay on one site than you would go to a second site to look up your news stories.
Okay, so given this view of constant growth, constant high-level growth, is there any price at which the likes of Amazon, Facebook, etc., would leave your portfolio?
Yes, of course there is. And really the test that we apply is that can we double our money, or can we reasonably hope to double our money in the next 5 years? And as these companies have got bigger, and actually size itself becomes a constraint, because you rub up against regulators and governments and policy, and there can be social resistance simply because Amazon's everywhere and Facebook's everywhere. So absolute size can become a problem. But if you look at the markets that they're exploiting and the growth, the move to mobile, both for e-commerce and for advertising, there's still a huge amount of momentum to go to. So we've recently been looking at both Amazon and Facebook. Can we double our money again? It's getting harder than it was 2 or 3 years ago. But we still, on what we think are not completely implausible assumptions of market share and so on, we still think we can get there. And that's been the thinking. That's why the big thing that hasn't happened over the last year or 18 months is we haven't taken any money out of Amazon, Google, Facebook, Naspers, despite the fact they've been amongst the best performing stocks in the world. So they become larger parts of our portfolio. And we haven't, because we can see the markets they're addressing growing very rapidly as well. So the other leg of it is not just that Facebook's existing business or Amazon's existing business is scalable and the profits will be growing rapidly. It's what we can't really see under the bonnet, but we know that these are the companies that are the biggest investors in R&D in the world at the moment. There's a very small number of companies that are continually addressing potentially huge markets, whether it's artificial intelligence, virtual reality, autonomous cars, healthcare, medical discovery. I mean, that's one of Google's big areas. The lead investors, it's always 2 or 3 of Google, Amazon, Microsoft, Facebook, Samsung. They're the guys who are there all the time. And in the meantime, the rest of the corporate sector, look at the health sector, for example, the big pharma, they're cutting R&D and they're cutting development spend. The big oil companies are sort of, they're not investing in new alternative energy. One or two of them are, but most of them aren't. And they're going to miss out on the next generation of growth because they're not investing.
Interesting. So one of the things that you look at when you're looking at stock is how big is its R&D budget? What's
yes, well, this is another theme that we've been looking at. But are they reinvesting? Are they ploughing profits back to secure a growthful future? And
quite brave when what everyone wants is a big dividend.
Exactly, but this is what sets them apart, and it's, I think, what to an extent sets us apart in being prepared to back them, because you're not going to continually be able to double your profits, double your money, if you're not investing in the future, in new products, in new markets. And one of the very good examples is, and I know a lot less about this than a number of my colleagues do, but large part of Amazon's value at the moment is AWS, the cloud web services business, which 5 years ago none of us were talking about. No one knew anything about. But it was, if you like, a moonshot. It was a big business that Amazon were investing a lot of money very quietly. It's probably now 40 or 50% of the valuation of Amazon. And in 5 years' time, there will be other businesses, quite possibly, probably artificial intelligence based in some way, where they're also at the moment investing tens of millions of dollars. And we don't know what they'll be, but that's why we're backing.
But we know they might be out there.
We know they might be out there, and we know that the management are investing for the future. They have a vision and a mission, and they're ambitious. And I mean, I think if you really want to make money in equities, you have to follow the ambitious.
Well, you have to be optimistic, don't you?
You have to be optimistic. You do. You do. No one ever doubles your money by being, risk averse. I mean, either your investment manager, but more importantly, Jeff Bezos or Bill Gates, or none of them ever said, how do we sort of avoid making a mistake? They're all prepared to make mistakes. They're all very flexible in trying lots of different things and changing their mind, closing down the ones that aren't working and supporting the ones that are. And yet at the moment, a lot of activist funds are trying to make every company be prudent and careful and give the capital back.
What's the stock you have most confidence in from this category? If you had to be, to go and sit on a Bahamian island for 10 years and there was one of these really interesting growth stocks that you had to buy and just leave, which one is? That's
really difficult because a lot of the favourites, the winners, are now getting to a market size that is it's quite hard. We can see Amazon doubling, but can we see it doubling again? Because that would make it a $1.5 trillion company, twice as big as any other listed company's ever been. So absolute size and political power becomes a problem with those. I mean, I would probably either go with a smaller, earlier stage wannabe Amazon in a different vertical, or I think I had a meeting earlier this week with one of the founders of Ctrip, the Chinese online travel agency, who, partly because they've done a very good job with their own services, but also because they've been very adept at wheeling and dealing. So they've recently taken over their number 2 and number 3 competitor in the Chinese online travel agency market. So they now have something like 70% or maybe more than 70% market share in online travel bookings in China. As we all know, the Chinese are traveling. They're beginning to travel. Their discretionary spending's going up. So it's not just business travel. It's also, and it's not just international. There's a lot of inward travel for the Chinese. And Ctrip, through both good operations and good politics, has found itself with the dominant market share in a very immature market. So the market's growing at 20% plus. They say it's going to grow at 30% a year for the next 5 years. If it does, we will be making multiples of our money on that one, and that's a recent purchase for Monks.
Okay, so you'd be happy holding that while you sunbathe?
I think so, because I can see it in 5 years' time. It could be 4 times the size. It'll still be smaller than Amazon is today, but by then it'll be approaching a global online travel agency with all the benefits of scale
and does that make up, a company like that, does that make up an appreciable percent of the Monks portfolio? Because you hold quite a lot of stocks, don't you? How many do you hold now?
The total portfolio is just over 110. There's probably
a lot of companies.
Yes.
That's well,
I think there's an interesting, there's 2 responses to that. The first is that the 40 smallest holdings we've got only make up about 20% of the portfolio. And we intentionally run a basket of higher risk reward, earlier stage, less proven growth stocks. So companies that, if they succeed, will make a multiple of our money. But they might not. There's quite a high risk that they won't succeed, but then we might lose once our money. And I very firmly believe that those odds are terrific. If you can make 4 or 5 times your money but only lose once, you want to take lots of those bets.
Depending on how often you lose, of course.
Depending on how often you lose, but you want to make we want to get lots of those opportunities into the portfolio. So there's 2 approaches to managing that sort of risk that the companies might go wrong. One is to stay not involved but monitor them until you know they're going to succeed, by which time the stock's probably already risen 100%, but then you're buying at a lower risk stage but also with lower reward. Or you buy a small holding, a basket, and as long as 2 or 3 of them succeed out of your basket of 7 or 8 or 10, you're going to still be ahead of the game. So that's what we do, and we have done back testing that shows that it's these higher risk reward companies, what we call our incubator holdings, they contribute disproportionately to the positive performance. So typically they're about 20% of the portfolio and about 30% of the value added. So they're worth doing as a whole, but it would be quite easy to knock them out and get down to 65 holdings. Or 75 holdings if I got the numbers right.
Well, the other thing was, there's an enormous amount of work for you to know everything about 100 plus stocks. I know you've got 2 deputies, but nonetheless.
That's the second point I was going to come to, that the approach that my team has, the Global Alpha team, which is now running Monks, is that we're not a separate team sitting in a corner office doing our own thing. We actually are sitting right in the middle of the whole investment floor. And both through informal processes and formal procedures, we are we're set up to try and extract all the best ideas from all of the analysts in the firm. So we see ourselves as a vehicle that can reflect the best ideas of Baillie Gifford, who now have over 100 investors working on the investment floor here in Edinburgh, rather than a team of 5. And it's a very different philosophy from the philosophy that Scottish Mortgage follows, which is a separate team and a more concentrated portfolio. They've got a bigger team than us, so they can
But presumably you communicate with them as well.
Yes,
you've got a lot of cross-holdings.
But they basically generate their own investment ideas and their own portfolio, whereas we are happy to take ideas from anywhere. We're not at all proud. In order to get into the portfolio, it goes through a screening process, and ultimately the decision is Malcolm, Spencer or mine. So the 3 fund managers, we're fully accountable for all the decisions, but we have relationships with lots and lots of investors who bring their favourite ideas to us, and they get a fair hearing, and a fair number of them get into the portfolios. So I don't need to be an expert on every stock in the portfolio. I just need to know who upstairs.
You need to rely on somebody else being an expert.
Yes.
Yeah.
Yes.
Okay. Now we've skipped 2 growth.
Yes. Well, we always get stuck on rapid growth because it's
so we need to do those very quickly because we said them before. We have to explain quickly what the other 2 categories are.
The other 2 I find great fun because this is where you get into market inefficiencies. So the next one is cyclical growth. Companies that categorically don't grow every year. We don't expect them to grow every year, but they grow through cycles. So trough to trough, peak to peak, they grow over the long term. And if the companies there that we're looking for are the ones with the really clever management who recognize that they're in cycles and who can allocate capital appropriately. So essentially the ones that deploy their capital at the bottom of the cycle when assets are cheap and profits are depressed, and then hold back at the top of the cycle. So the opposite of the British banking industry that did all its acquisitions in the early 2000s when everything was booming.
And the opposite of most of the mining industry.
And the opposite of most cyclical industries, because they all get overexcited. Everyone opens a new mine when metals prices are high, and then they've all run out of money when everything's in a slump, and actually you could pick up assets at half the development
So
cost.
this is basically capital cycle investing.
It's capital cycle investing, but it's where we would put most of our banks, most of our insurance companies, it's
basically you've just found a way to fit every company in the world into one of your growth categories.
What we've found is a way to fit every growth company in the world into our portfolio.
Okay,
because there's not, a huge raft of companies and industries that, as you just mentioned, we've just written off oil companies, mining companies, banks, big pharma. They don't fit in any of our growth categories. So, we are literally trying to find the best 25% of companies in the world. And I just think that growth, defined as above average growth over rolling 5-year periods, is quite a broad church.
It clearly is.
You can look further than the internet, and you can look further than biotech. And you can get a diversified portfolio. So just to round off the fourth one. Is what we call latent growth, which effectively are our deep cyclicals. These are companies that may be in industries that have been awful for years, I mean maybe even decades, but where something is changing that means that the future will be much better and different from the past. So typically, if you've got a very unsuccessful industry where no one's making any money, over time, people get out. They sell their loss-making subsidiary to someone else, and you get industry consolidation. And lo and behold, most consolidated industries are very profitable for the survivors. So we've got a number of, typically these are niches within industries, but you can look at Japanese non-life insurance. 17 players 15 years ago, 3 players today with 90% of the market.
Which one do you hold?
MS and AD insurance. You can look at the semiconductor, the memory companies. I don't know how many players there were 10 years ago, probably over a dozen. There's only 2.5 left now. Semiconductor testing. Well, there's 2 companies, and then there's Toshiba, which is partially involved and still a survivor, but isn't really an industry leader. Then semiconductor testing, the equipment that tests these chips before they go into our cars, and they drive our car for us. So testing's becoming increasingly important. There's only 2 companies now with 90% market share.
Okay, and do you hold both of those, or do you choose one?
No, we own the one that makes profits consistently and not the one that
Which
doesn't.
one's that?
It's called Teradyne. It's an American company, and its competitor's called Advantest, and is Japanese and has been losing market share year on year. And eventually you get to the position where another of our recent purchases for Monks, a company called Vico, who make the equipment on which LED light bulbs, which you need to make LED light bulbs. And we all know energy efficiency, LED light bulbs, going to be a huge part of the lighting market, dominated by the Chinese, who threw huge amounts of capital, far too much capital, at it from 2010 onwards. But there's only 2 suppliers of the hardware they need to make a high quality LED. And one of them is heavily loss-making and basically disappearing. The other is heading towards a de facto monopoly position. Now, at the moment, demand is still weak because the Chinese overinvested. Their factories can produce far more than current demand, but demand for these things is growing, close to 100% a year, high double-digit growth rates. So the capacity is closing, and when they want to start...
And which company is going to end up with the monopoly?
It's a company called Vico.
Vico, sorry, you said that at the beginning.
It's an incubator-sized holding, a high-risk reward holding in Monks bought earlier this year. So, if you look at these niches, consolidation is fabulous, but putting cyclicals and latent together, this is where our longer-term time frame, which you have heard about before from Bailey Gifford, really comes into play, because the stock market hates companies whose profits are falling. And everyone runs away and they all go and start buying Amazon because its profits have started going up, and that's why Amazon's where
you
it
just do
is.
both.
But it means that with these cyclical companies, they tend to trade at low, depressed multiples of depressed profits. So if we're right and the profits are going to recover, we're going to get a recovery in the profits and a recovery in the valuation.
Yeah.
So 2 levers to pull. So you can make it's actually easier to make money in the less efficient parts of the market, which are the cyclicals and latent growth stocks, than really it is in the stalwarts, where the virtues are very apparent to everybody, and rapid growth, where there's a glamour halo about them, and lots of people, everyone knows Amazon's a growth company, so where can we add value?
So it's the middle bit where the fun is for you.
Well, I think, but that's another feature of having 3 managers of Monks, 3 co-managers, is that we're all very different. And I like investing in cyclicals. Spencer likes investing in blue sky growth opportunities. Malcolm likes stalwarts. So, that's another reason why we have 4 categories, because we each have sort of favourite parts of the curve. Now, it doesn't mean we concentrate and we don't each run a sleeve. It's not like that. We all, every decision is made by the 3 of us, and we need at least 2 of us to want to buy it. But you just have preference. I really like companies that like this or like that. and they're different, and that's the benefits of a team that is a mix of personalities and skills.
Okay, well, we should wind up. We've been talking for ages, but just before we do, let me ask you about costs. Monks has a relatively low cost, doesn't it? Just around 50 basis points, a bit more.
Yes, the management fee is 45, which is what we get. The overall costs are just about 59 basis points last year. If the fund can stop shrinking and start growing, those costs come down.
Is the fund likely to keep shrinking?
Well, probably my greatest contribution to Monks so far in 18 months has been to halt the inexorable shrinkage in the companies. So most years over the last 15 to 20, Monks have been buying back shares. And since we took over the management 18 months ago, we haven't bought back a single share. So the number of shares in issue is the same as it was when I started managing it.
But the trust still has a reasonable discount.
Well, this is, yes, but we think there's a better way of narrowing the discount, which is to generate good performance, which will help generate new buyers, because the discount is just a function of the imbalance between the number of buyers and the number of sellers. So if we can generate more buyers, the discount will come in. It may be, and we've seen Scottish Mortgage do this, and Scottish American, another Baillie Gifford trust, they now trade at premiums to net asset value because they've generated new buyers. And we think Monks can do the same. So the discount has narrowed since we took over from 12 or 13 towards 8 or 9. We think it can continue to narrow from here.
And then if you end up issuing new shares, the fund grows and the costs eventually come down further.
Exactly.
Yeah. Exactly. Wonderful. I think I was going to ask you about macroeconomics and big things that you worried about and that kind of thing, Brexit, but I think we'll leave it there.
For a global trust, Brexit is a non-event.
I think it might be a non-event for quite a lot of people.
Yes.
Thank you very much.
No, thank you.